I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Andrew Lockhart, Managing Partner of Metrics Credit Partners. Andrew, welcome.
Thanks, Peter.
Your business is one of the successes in the local lending environment. Can you talk us through the evolution of Metrics?
Yeah, sure. We started the business back in 2008 inside National Australia Bank with a view that we would set up an independent funds management business if we were successful in raising third-party investor capital. And we did that because at the time of the GFC, we saw how difficult it was for companies to get funding. And so we launched in 2012, seeking to raise investor capital. After 12 months of marketing, we hadn't been terribly successful. We had one investor who committed an amount of $75 million, and that was enough to start us. And so in June of 13, we launched our first fund with one single investor for a commitment of $75 million. And we've been very fortunate now to grow that to in excess of $13 billion today. And we offer a range of different products for investors, including 2 ASX listed funds. So we've now grown to have around 120 people in the business, with a presence in Sydney, Melbourne, and in Auckland in New Zealand. So it's been great to see the growth and the success of the business, but that's come as a result of delivering on good outcomes for investors.
In fact, you saw a turned a crisis into an opportunity.
Pretty much, like when I think back, at the time, in the middle of the GFC, the banks were struggling to finance their own operations, and there was a lot of systemic risk in that the banks would sell assets to other banks, and so liquidity dried up. And as a result of that, we really saw how that adversely impacted Australian companies. And we formed the view that there was a lot of capital that goes into the superannuation system, and that we could provide investors, institutional investors, with an alternative to traditional fixed income, and that's how we started.
What are the key drivers for growth in your business, and have they been constant or have they changed over time?
Look, I think there are two elements to that. The ability to raise capital is important to satisfy the demands for provision of financing to companies. And so, from our perspective, we obviously have a very strong skill set to originate and to manage the risk associated with lending and completing transactions with various companies that we provide financing to. And so the challenge in terms of the growth of our business is the ability to raise capital. And so that requires us to continue to deliver for investors, deliver that stability of capital, deliver on the income objectives of the funds. And pleasingly now, over almost 10 years since we first launched our first fund, we've delivered and exceeded on all of our investment return objectives for our investors across all funds over that period of time. And importantly, we now have a strong track record of going on near 10 years of consistent performance in terms of management of risk. And so as a result of that, I think what we've been fortunate to be able to see is that investors have recognised our performance, our track record, the skill set of our team, and as a result of that have been supportive of our funds and our products that we've brought to market.
Have there been any speed humps or speed bumps or potholes along the way, or has it been relatively smooth sailing?
Look, I think in all lending activity, you're going to have situations where companies underperform or outperform. There have been occasions where we've had to manage credit risk more actively. I think back through the pandemic period, or back in 2015 when the commodity prices fell materially. There's been a range of areas where we've needed to actively manage risk. And fortunately for our investors, our team have a very strong skill set in terms of restructuring corporate workout scenarios and the management of risk, which has ensured that we've been able to manage through those periods and those individual transactions successfully without our investors incurring any loss.
What are some of the misconceptions in the non-bank lending arena, in your experience?
Yeah, I think people tend to think of it in the context of being a lender of last resort. If a borrower could borrow money, why would they borrow money from a non-bank lender? They'd surely go to a bank for financing. And I think our view is, well, no, we actually believe that we're delivering companies with a very valuable source of non-bank financing to diversify their access to capital. And so as a result of that, what we've tried to do is to differentiate our activities to perhaps what people have seen in the past, to demonstrate to the market that we provide institutional quality products and that we can meet the market demand in a manner that is competitive with the banks. So we work with the banks to provide financing and we compete against the banks to provide financing to a range of companies. So I think from our perspective, we've tried to differentiate our activities as private debt has become more mainstream in the market.
We're in a volatile environment now and a changing environment. How do you manage these issues for your investors going forward?
Importantly, Peter, when we lend, our focus is on ensuring that the company that we lend to or the project that we're financing is going to deliver sufficiently strong cash flows to service and repay the debt. And in volatile markets, you also have to have a view in terms of any potential risk around the valuation or enterprise value of the company. And so from a lender's perspective, we look long term at industries and businesses, how have they performed over long periods of time to determine what is the appropriate capital structure that will sustain that company to ensure the company can service and repay their debt. I'll give you an example. If you think about volatile sectors, you can have a sector, say a sector that might be exposed to commodity prices, foreign currency risk, production issues. There's a lot of variability in those cash flows. And as a result of that, a lender needs to understand all of those volatility or volatile drivers of cash flow to determine what is the appropriate level of debt that can be provided. And so the ability to manage a company's capital structure and to ensure that the company is generating sufficient cash flow to service and repay the debt is the way in which we would manage through volatile or more difficult times.
Is managing risk getting more difficult or is it just changing?
Our role is to look at long-term drivers of cash flow and what is the company's industry position, what is its strategic direction, what will drive that company's earnings, and then work to determine what are the risks and then seek to mitigate those risks from our lending. And so, that takes the form of appropriate covenants, controls, taking security are designed to mitigate our risk. And so as a lender, what our role is to understand is what are the key drivers of cash flow that this company is generating, and then what is the long-term sustainable debt capital structure that it can support.
We're in a higher inflation environment at the moment. Does that make it an easier sell to investors that you can offer a prospect of a higher return?
I think investors are looking for assets that can be a hedge against inflation risk. And certainly from a private debt market perspective, the loans that we make are floating rate. And so as the RBA raises cash rates to contain inflationary pressure, then obviously the total return to our investors increases. What we look at is the spread that can be generated for an investor, the spread being the difference between the base rate and the total return that's being generated for investors. If you look at our funds, going back over a period of, say, 10 years, that spread differential has been very consistent. And that's delivered for investors through fees that are charged to companies together with margins. So the fees and margin that we apply based on the credit risk is what drives the total return for investors.
Can we put some numbers on that spread, which you say is pretty consistent over time?
If you look at our publicly listed vehicle, MXT, I think over the last 5 years, MXT's delivered a return of close to 4.35% over the RBA cash rate, consistently now over 5 years. And so as interest rates are rising, the base rate, RBA cash rate is increasing, that spread's being maintained. So you can see that's an attractive source of income for investors.
What are the key traits of private debt and lending that demand a position within a portfolio?
I think it's the absence of volatility, that's capital stability. If I think about it, there aren't too many other...
Traditional defensive reasons, really.
Yeah, well and truly. If you think about most other asset classes or investment options, the investor doesn't necessarily have the manager negotiating and structuring the terms of the transaction. Our role is to deliver financing to a company. but our role is to also ensure that our investors' capital is well protected. And you do that by negotiating appropriate terms, conditions, covenants, taking security, and then lending to companies that are going to demonstrate consistency of cash flow that can service and repay the debt. But equally, we've got multiple ways in which we can exit the investment to ensure that our investors' capital isn't at risk.
Can you talk us through the risk profile of the companies that you do lend to? Are they similar, or is there a broad spectrum?
It's a broad spectrum. I always say, credit or fixed income, private debt is not a homogenous asset class. At one end of the spectrum, you can be lending to high investment grade companies. At the other end of the risk spectrum, you can be lending to sub-investment grade companies. But equally, you can lend through the capital structure from, a senior unsecured debt through to equity. It really depends on the nature of the transaction, and our role is to identify what are the key risks associated with providing financing to that company, and then to mitigate those risks to ensure that our investors' capital is protected and preserved. And we do that through appropriate terms, conditions, monitoring of the risk, taking of security. All of those things come together to protect and preserve investor capital. But the investment that we've made in direct origination is a means to drive fee income for our investors.
What's the long-term outlook for private debt at the moment?
I think it's positive, Peter. I think there's a growing acceptance from investors that they are looking for an asset class that delivers stability and an attractive source of income. And so, unfortunately, investors in traditional asset classes have had a rough time over the last 12 months. And so that creates an environment where investors are looking for alternatives. And given the performance of our funds, that has attracted investor interest. And so I think
there's more people knocking on your door now.
Well and truly. And I think that demand for our investment products will continue to increase, provided that we deliver on our commitments to our investors, which is that maintenance of stability of capital and drive our income to deliver an attractive return for our investors.
I'm an investor. What should I be looking for from a private debt or prospective private debt manager?
Oh, look, I think there are a range of things. I think having a skilled team that can originate transactions, to structure terms and conditions to mitigate risk, well-diversified portfolios where you're reducing the exposure you have to any one individual borrower, liquidity, the ability to manage liquidity. How do you get your money out if you're an investor? The fees and costs, all of those sorts of things are important. I think our view has always been, to provide well-diversified portfolios to lower investor risk, increases the level of liquidity that's available to our investors, but equally through size and scale, we've been able to offer lower fee products to our investors, and that's been important.
Andrew, thanks for talking to us today.
Thanks, Peter.